Palantir grew 85%. Its stock fell 35%. So, here's the puzzle. Palantir is the hottest stock of the AI era. The retail favorite. The company whose software the government and the Fortune 500 run on. Last quarter, its revenue grew 85% to a record, and it was the 11th straight quarter that its growth actually sped up. Then it raised its outlook for the year. The business has never ever looked stronger. And in the middle of all that, the stock fell about 35% from its high. A company firing on every single cylinder, and the market sold it. How does a business get better and better while its stock goes down? The answer has nothing to do with the business. First, understand just how expensive it was. Palantir traded at around 140 times its earnings, and about 40 times the revenue it will make this entire year. The richest valuation of any large software company in America. Let that land. Most quality software trades at maybe 10 times sales. Palantir was at 40. A number like that isn't really a stock price. It's a promise. A promise that this company will keep growing at a blistering pace and keep its fat margins for years and years into the future. When you pay 40 times sales, you haven't bought what the company is. Reason 2, flip that promise around and it explains everything. To justify 40 times sales, Palantir doesn't just have to grow. It has to grow at breakneck speed for years, almost flawlessly. So when it reported 85% growth and guided to 71 for the year, numbers that would be the envy of nearly every company on earth, the market's reaction was a shrug and then a sell. Not because it was bad, because the price had already assumed it. The bar was never grow fast. The bar was beat a future that's already baked into the price. And the blowout that merely meets an impossible expectation in a stock like this goes down. That's the trap of a promise stock. Good news is only good if it's better than perfect. Reason 3, here's the actual trigger. A stock priced entirely on far-off future profits is the most sensitive thing in the market to interest rates. And in the first half of the year, war and stubborn inflation forced the Federal Reserve to hold rates instead of cutting them. And then to stop giving guidance at all, leaving hikes on the table. When the discount rate stays high, $1 of profit 10 years out is worth less today. Nothing about Palantir's business changed in that stretch. Its growth actually accelerated. What changed was the value of its distant future, marked down by the math of higher for longer rates. That is why quarter after blowout quarter kept getting sold. The company delivered, the discount rate took it away. Now the honest other side, because this is not an empty hype stock. Palantir has real profits, genuinely accelerating growth, and a real lead in actually deploying AI inside big organizations. The bull case is that it simply grows into the price. If it keeps compounding north of 70%, then a few years from now, today's valuation looks cheap in hindsight. Exactly the way Nvidia and Amazon looked insanely expensive, right before they grew into and past their multiples. So the falsifier is precise. Watch whether growth stays above the roughly 40% plus pace the valuation needs, for years, not quarters. If it does, this 35% drop was a gift. If growth cools even a little, a multiple this high has a very long way to fall. So, step back. The market was never punishing Palantir's business. It was repricing its promise. And this is the one lesson that outlives the ticker. A great business is not the same thing as a great stock. The multiple is the price you pay for the future. And when you pay 40 times sales, you've already paid for years of perfection in advance. The tell was never the 85% growth headline. It was the gap between that growth and the growth the price already required. This is the tell for any narrative stock at a sky-high multiple. The question is not, is the company good? It almost always is. The question is, how much of that good is already in the price? Because that gap is the only thing you actually own. So, back to the puzzle. Why did the fastest growing software company in America fall 35% while its business accelerated? Because the stock had already priced in a decade of that acceleration, and the only thing that changed was the market's willingness to pay today for a distant future. The business is real and it is winning, but the price is a bet that the future arrives on schedule and without a stumble. Cisco once did this. Through the year 2000, its revenue kept climbing, yet the stock fell some 80%, because the price had front-run a decade of growth that came slower than promised. So the verdict is precise. The business is intact. The valuation is stretched, a promise the future still has to keep. When you buy at 40 times sales, you are not buying the company. You are buying its next 10 years today. This is analysis, not advice.